In this presentation, we will record loan payments on an installment note within QuickBooks Pro 2019. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Our goal is going to be able to break out the interest and principal portions of the loan payments as we make the loan payments and be able to record this when we're going to have to record to 3 accounts. In essence, we're going to have to make the payment decreasing cash, record the interest, and record the payment into the accounting software. Here we are in the home page. We've got the open windows open. You can open the open windows by going to the View tab and open Windows Lists. Our goal now is going to be entering the loan payments for an installment agreement. Let's go to the reports to see what this loan is that we will be paying. So we're going to go to reports up top. We're going to go to the financial company and financials. We're going to go down to the balance sheet standard. Balance sheet standard. I'm going to change the date range to the periods we are working on. So I'm going to customize the report and change the periods from 01/01/19 to 12/31/19. And we're going to say OK. Now what we're looking at is the liability. We have this loan down here, this $72,000 loan. I'm going to double click on that so we can see more detail of it. And you'll note that it really is 2 things that happen here. We had the beginning balance of 22 and 50. We're basically going to say that that's the first starting point of the loan, and we're going to start making payments on this loan. So the payments will be interest and principal that we're going to end up paying. Now, as we make payments, it's usually pretty easy to know what we pay because we'll probably get a bill saying you owe this money or some kind of notification saying that you need to make this payment. But it's not as easy oftentimes to know how much of that payment is interest, how much is principal. So to think about that, first let's consider this loan in Excel. So we're going to jump over here to Excel, and I'll work through this. You can work through a similar problem in Excel, or if you have Google Sheets, you can just use a similar calculation within Google Sheets. This is just a really common thing that happens in terms of loan agreements, meaning if you get a loan agreement, if we got a loan for whatever reason, we wanted to get cash in the business, or we bought something like equipment and took a loan out from it. Oftentimes the agreement's going to tell, if we read through it, we read through all the legal mumbo jumbo, we're definitely going to get to something where we should be able to find the loan amount. That should be pretty easy to do. We can get the number of payments, like how many payments we're going to have to make. This would be in months. They may give us year. They may say something like, you're going to pay something for 5 years, monthly. If they say something like that, then of course we would say, okay, well 5 years times 12 months in the year would be 60 months worth of payments. So the number of payments would be 60 on a monthly basis if that were the case. And then they're going to give us the rate. Usually we'll find that on the loan. Sometimes they don't even give the rate though, and they only give the payment amount. And that's possible to do because if they do that, you could derive the interest rate. But normally, if it's a straightforward loan, they'll say, hey, here's the payment amount, and here's going to be the interest rate on the loan. So we should be able to find this information, and this is usually the one that they give us because oftentimes they're trying to decide if we can make the monthly payments. And so it's going to be broken down to this number here. So this is typically what we have. But when we make the payments, we still have a problem, because we don't know how much of each payment is going to be interest versus principal. To know that, we would need an amortization table. So an amortization table is not something that they provide us oftentimes because the amount of this payment between interest and principal will differ with each payment. So they don't often give us the amortization table. We can derive it, or it's often something you can get from your CPA firm or your accountants that you might work with at the end of the year. Whether you're a bookkeeper or a company, you can work with an accountant that might give you that, or come up with a simplified method to be able to make an adjusting entry at the end of the time period. So we'll talk a bit about those as we go. So for now, let's just make one of these payment schedules to see what it consists of and kind of why we have to break out and why this is an issue. So I'm going to basically just say, okay, there's going to be 60 payments. I'm going to start with 0. So we're at time period 0, and then 1, 2, 3. And you can autofill this all the way down. If I select all of these items here and put my cursor on this little, so it looks like that, not like that, but like that, then we can left click and drag it down and see how it's numbering there. I want to go to 60 payments here. So we're looking for 60, and that's what we're going to end up doing. So Excel allows us to autofill this down. Then we're going to try to populate the rest of this item. So in period 0, we have a loan that's equal. I'm going to use the equal sign, this 72,000. That's our first loan. The payments that we're going to make are always going to be equal to this. We've standardized the payments. So we know that. What we don't know is the interest. The interest is going to be calculated at the principal, 72,000, times the interest rate, which is this number, which as a decimal is 0.05. We moved the decimal over 2 places. 0.05. That's the interest for a year. Interest is usually represented in yearly terms, because if it was monthly terms, it'd be a very small number. So we usually say interest as a year. If we want to make it a month, we're going to divide by 12. So that would be the interest we owe in a year divided by 12. That's how much we owe in the month. The other way we can do it is we can take this 0.05 divided by 12. That would be the monthly interest rate. You can see it's very small, which is why we don't usually express interest rates in that format. But then we're going to multiply that monthly rate times the principal, 72,300. So I'm going to do that same calculation here with Excel. It's going to be equal to this number times 5% divided by 12 months. So that's how much of this principal is interest. And therefore, that's how much of this payment is interest. So the reduction in principal is the difference, meaning this number is the full payment minus this that is interest, the difference being how much is going to be reducing principal. So the principal amount then is going to go from 72,000 down, not by the full payment, but by this number, the reduction in principal. So our breakout between, we're going to make a payment of this and break out interest and principal in this format. So if we did this, if we kept doing this, we know that the second payment is still going to be the same amount. The amount going to interest, however, is going to differ because the principal balance has differed. So the amount going to interest is going to be equal to this number now times 5% divided by 12 months. And then the principal is going to be equal to this number. The payment's the same, but the interest has gone down. The rent has gone down because the principal went down last time. And therefore the amount of principal reduction went up. And therefore our principal is going to be equal to last time's minus this principal reduction. So I'll do this one more time. And our goal here isn't really to be able to make these. Our goal is to make the amortization schedule so that we can use it to enter into Excel. And again, if you can do this, if you're comfortable doing this, that's great. If not, there are some workarounds to put this information into an Excel and work with possibly a CPA firm or accounting firm at the end of the year that'll help you make just an adjusting entry. So it just depends how you're entering the data into the system. Let's do it one more time and then we'll copy it down using Excel. So this equals the same payment. Interest is going to be equal to the principal that we have here times the 5% divided by 12. The principal reduction is going to be equal to this number, payment, minus the interest. And then the principal amount that's left is going to be equal to this amount minus this amount. And just for spelling purposes, I think this is principal. Which I always spell wrong. Okay, so now I'm going to try to copy this down. I'm going to highlight these cells and see if we can autofill it down and see if Excel just does what we would like it to do. So I'll put my cursor on this item and drag it down. And notice Excel did something funny. So something's wrong here. And we could see what's wrong. If you double click on it, it picked up not the 5%, but this number. And that's because we didn't use an absolute reference. Everything else is going to be brought down, but I don't want it to move this number. I do want it to move this number down when it goes here and everything else, but not this number. Now, so the way to fix that, I'm going to delete this. The way to fix that is to make this an absolute reference. You do that by putting a $ before the B and a $ before the 3. We only need a mixed reference, but I'm going to do an absolute reference. The other way you can do it is just put your cursor right between there and push F4 on the keyboard. and it'll type a $ before the B and a $ before the 3. Now this has nothing to do with like money. This is just code for QuickBooks. I don't know why they chose a $, but $ just means it's an absolute reference. It means don't move that cell when we copy it down. That's all it means. So if I say enter, do the same thing again, highlight these 4 cells, autofill to the right, drag it down 1 time, then check if it does what we want it to. This looks correct now. This looks correct now. This looks correct now. So it looks like it's doing what we want. So what I'm going to do now is highlight these 4, drag it all the way down to the 60 payments we have. So I'm going to put my cursor right here, go all the way down to the 60 payments. So we're going to go all the way to the 60 payments, and it should end up, if we do it correctly, at 0 here. And that's our check number. That's kind of like, okay, if that works, then we did it correctly. If this isn't 0 at the end of this, then something's wrong, and we'll have to fix it. So that's how we can check if our amortization table has been done properly. What we're going to do now then is enter the payments for these first 2 time periods. And you'll note that every time we make a payment, it's going to be the same for the dollar amount, but the principal and interest will always differ. And that means that QuickBooks can't really just remember what the payment is, because it's going to be different each time. And that's kind of the problem with the amortization schedule. Okay, so let's go back to QuickBooks. Now there's a couple kind of ways you can if you don't have that amortization schedule, then there's a couple of things you can do. You could say, one, you could say, hey, I'm going to work with the CPA firm. I'm not going to make an amortization schedule, and I'm not even going to record according to it, because it's going to make it so I have to figure this out on the amortization schedule too much, and I don't want to do that. Or possibly I'm working with a team and I don't want the accounting department to have to do that. I want the accounting department to just memorize the payment, and therefore I want to make the payment always the same. I don't want to have to break out between interest and principal a different amount each time I make the payment, because I would like to standardize my transaction. Whenever I enter the bill, in other words, I would like it to just be able to memorize what happened last time, and that would be it. So the way you can do that is basically to work with the CPA or make an adjustment, plan to make an adjustment at the end of the year, and just say, I'm going to make a payment. It's going to reduce cash. I'm just going to write a check for the payment amount, which is this amount each time. And I'm just going to write the other side to reduce the loan payment. And that's it. I'm not going to record interest at all. And if you do that, then at the end of the period, you can at the end of the month or the end of the year, you can work with a CPA firm and say, hey, you're going to have to derive the amortization table, or here is the amortization table. We have just recorded all of the loan payments to the loan payment account, and we need you to make the adjustment to break out the interest versus principal portion. Here's our loan agreement. Please help us to do that. And that's one way you can kind of standardize the accounting process and not have to enter a different entry each time. If you have the amortization table, then we can use it to enter a different entry each time. That's what we're going to do here. Now there's a couple ways to do this. One is by the check register. That's what we're going to start with. So we're going to just enter a check into the check register, go to the banking up top. We're going to write I'm going to go to banking. We're going to go to use register, and then we're going to go to the checking account and say okay. And then our register will be here. I'm going to make this as of 02/01/21. So this is going to be our first payment, and we're just going to make it as of the beginning of the time period. I'm going to make one at the beginning of the month and one at the end of the month, just so we can see them both in the same month. So it's going to be our problem's going to be a little off in time periods, but our goal is to see that the two entries are going to be different in nature, although very similar in format. Okay, so we're going to say that the payee is going to be Chase. That's who we borrowed from. We're going to make the payment for, and again, if we look at our schedule, it's going to be for this first payment, $1,359, and that'll be the same each time. So the payment's the same each time. It's going to be $1,359 according to our amortization table and the bill or whatever we have. Now here's the problem. We have this one other screen here. I need two things. I need interest and principal, and I only have one other account line. So the way to get two other account lines or more is to hit this splits item. So if you have two or more accounts you need to hit, doesn't mean you have to go to a journal entry, or doesn't mean you have to go to some other input screen like a check. You can use this input screen and you just select this item, and as long as these amounts that we add up here add up to the dollar amount here, then we'll be okay. In other words, the dollar amount will be reducing the checking account, and these are going to be the other sides of it that we will need to balance. So the two sides are going to be interest expense, interest, and notice I'm just typing it in there, and it should appear because we didn't enter it, but the system did. And most any type of company we set up, QuickBooks will give us a trial balance if we ask it to, which that'll be the default that we will. And most of them will have an interest expense related to it because it's fairly typical for most companies to need one at some point. Now the interest expense amount is the one that we need to get here. So for the first payment, it's going to be $300. So that's our interest amount for payment 1. So we're going to say that it is 300 here, 300. And then the memos, you know, we might want to put something like first payment on note or something like that. And we may want to put that all the way through so it lines up and is in all of our accounts. So if I double click on the interest expense, or I zoom, or I look at the detail for interest expense, it'll give me a note there. And then we're going to say that the principal then, which is going to be the loan amount, so this will be the actual reduction of the loan up here. If I hit the drop down, it's going to be the loan payable. So you also could type it in there. And that's going to be this number. It should populate automatically because that's what we need at this point in order for our journal entry, in essence, to be in balance. That should match what we have here. So 1059. Once we enter this, we should be at this balance, $70,941 in the loan amount. Let's see if that is indeed the case. And so we're going to do that. We're going to put the same memo there, and that's going to be it. So make sure to record it here. So we're going to say record. And then let's check our financials and see if it does what we would expect it to do. We're going to go to reports up top. Actually, the balance sheet's already open. Let's go to the balance sheet first. We're going to go to the balance sheet in the open windows. And we're going to say that we have our loan amount. And it doesn't look like it changed here. It didn't change to me. If I look at this balance, it didn't do what I expected it to do. And I'm going to say, well, why? What happened there? And I'm going to go back to my checking account and see this transaction. And I'll note that I put it in there as of 2021, which is a prior problem I was working on in a future problem as of 2021. The dates that we are working on is, of course, 2019. So if I was to see this, if I was to go to this balance sheet and go to 2021, then I would see it. And just note that that's going to be, a lot of times if there's a problem in your financials, it could be a date issue. Now, if I had the check figure on, whereas I was working in real time and I told the system to tell me if I was 30 or 90 days over a certain time period, it would have given me an error sign. It said, hey, you're entering something in 2021. Maybe that's not right. But when we're working problems that are practice problems, we turn that error sign off. But in practice, that could be a useful thing to have limits and errors to tell you when you enter a date in some way. So I'm going to go back to the checking account now, and I'm just going to change the date here. And again, this is another area where to be completely proper, we shouldn't probably change the date, but reverse it or void it, and then enter it again. So we see the error in the audit trail. QuickBooks, however, allows us to change the date, and as long as we're within the same time period and are very sure of what we're doing, then we can change the date because it will be the easiest thing to do. However, we want to be very careful when doing so, when changing those dates, especially if they are in prior time periods. So I'm going to change this to 19 and say record it again. And so you have changed it. I'm going to say yes. We'll go back to the balance sheet. And now I'm going to change the date back down to 2019. And there we have it. So I'm going to double click on this item and change the range from 010119, and there's going to be our payment. So if I double click on that payment, it's going to be the check. Now note it doesn't go to the register, it goes to the check being the driving documentation. I'm going to close this back out, and note here, of course, that this amount matches the $70,941 is the $70,941. So that side looks good. If we go to the other side, it's going to be on, well, of course, the other side is on the checking account. So if we go to the checking account and change the date from 01/01/19, we see the check here that we have made for the full payment amount on our amortization schedule, going back to QuickBooks, and then the closing this back out, and then the profit and loss going to reports, company and financial, profit and loss with the income statement, changing the dates from 01/01/19 to 12/31/19. We'll see the interest expense down here. There's the 300 interest expense. And again, if we double click on that, we'll get to our same transaction. So there is that one. Now I'm going to record one other one, the second payment, just at the same time, just so we can see the difference between the two. And we'll record this one as of the end of the month. So it's still like kind of a month away. We recorded two in the same month, but one was we recorded it at the beginning of the month and the other at the end. So if we go back to our schedule here, we just did this one, and I'm going to go to this one now. Now it's useful sometimes to kind of make them a different color. I'm going to right click and make this green. That's the one we're working on, the green one. So we'll do this one now. The payment amount will be the same, but the interest and principal will differ. So I'm going to go back over here. We're going to go back. Now this time, I'm not going to go to the register. When it closes this, I'm not going to go here and enter it here. We're going to go to actually entering a check. So if we go to the home page, we can enter the check here, or of course we can go to the drop-down banking and write a check. So let's just actually write a check this time and do the same process but in a different format. So here's the check form. Here's the check number. It looks good. It's auto-populating to 2021, which is clearly wrong. So I'm going to make this, now we're going to make this as of the end of the month, 02/28/19. So we're working a little bit out of order to start off here. And the reason is that we're not just going to go straight through the month in this case, because we want to do these two payments next to each other so that we can see them, see the difference between the two types of payments we'll have for an installment note, how they change over time. So this is a month later that we're entering this data. It's going to go to Chase again, and we're going to say that the amount is going to be the 1359, the same dollar amount, and then we're in the expense tab. Now note here, of course, we have the multiple tabs. We don't have to hit the split screen or anything to get multiple tabs. We have them here. The first side is going to be interest expense. So it's an interest expense. And the amount, if we go back here, is going to be, now it's only 296, and that's the difference here. So as we go, these will all be different. And notice that there's no way for QuickBooks to kind of auto-populate this. That's kind of the point. It can't really help us out in that fashion by just auto-populating the information. We're going to have to always go back in here and say, okay, this is a different number, 296. I can't just look at last time period and make it the same. And then the loan principal amount is going to go down by the difference, which will be the 1,063. And if we go back to our schedule, there it is there. Our principal amount should be after we record this, 69,878. So let's see if that is the case. We're going to minimize this and save and close. And then we'll go to the balance sheet. And we will say, okay, cash should have gone down, of course. Double clicking cash. Changing the dates. Beginning date 01/01/19. And so there's the second cash amount. Notice these two are the same. Closing this back out. However, if we go to the loan balance here, here's the loan balance. 69,878 matching our schedule, amortization schedule. That looks correct, so that's good. If we double click on this amount and change the date range to 01/01/19, we see that these two amounts differ because the principals differed with the two payments. So that's what we want to note, that's what we want to see. Closing this back out, we're going to go to the profit and loss now. And then interest expense, here's the other side. Again, if we double click on this, these two amounts differ. So that's what we want to note. We can't just copy the last time period in order to work through this. So we're going to close this back out. Interest, of course, is the amount that's decreasing net income. Interest expense is going up, bringing net income down. We're currently at a loss of 6,817 for the year to date. One other thing to note here, if we go back up to the balance sheet up top, you might see this loan payment and you might notice, hey, it's in long-term liabilities. And you might be saying, well, there's a short-term and a long-term portion here, because if we go to the loan here, you can see that we're going to pay at least a year of it in the short-term time period. So maybe it's, part of, in other words, this amount of the principal, 12 payments out, 1, 2, 3, 4, 5, 6, 7, let's say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, that $13,109 is going to be paid within a year, meaning it's going to be kind of current rather than long-term liability. And that's going to be another kind of issue we have with reporting, because an installment note has a current portion and a long-term portion. Everything after that time period is what we're going to report later. Now, typically, most people will not try to record a short-term and long-term portion of the installment note as we go, because doing so would mean that we would have to adjust the short-term and long-term portion each time. So this is another area where you typically would want to report it in one place. I would say long-term, typically, if it's going to be something over a year, and then make an adjustment periodically to report the financial statement. So it would be an end of the period adjustment, breaking out the short-term portion of this note and the long-term portion when we're presenting the financials to someone else, rather than trying to make that adjustment each time we make a payment, because it would be the benefit we get from that added information isn't worth really the time that we have to put in to adjust that each time. It's something that would be easier to do periodically as we report and show the financial statements to others. One other thing to note here on the preferences side is that now that we've entered a few transactions, if we go to the check bank register again, the check register, banking, use register, check register, and if we type in another transaction for Chase just to test it, we're not going to record it. But notice that if we want this information to auto-populate, there's a couple different options. We can go up to the preferences up top and go to the preferences. So we're in edit and then preferences. And then we can change within the general settings, we can change this item here. So it's currently the default is to pre-fill accounts for vendor based on past entries. The other is to automatically recall last transactions for this name. If we select this one, what'll happen is it'll basically pull in the full dollar amount and everything for the prior transaction, which if the transaction is all the same is useful. If the transaction is different, then we would have to go through and change the dollar amount. If we choose that item, then we select OK. Now look what would happen if I entered another transaction for Chase. We're not going to record this. We're just testing here. We're going to say Chase. It's then going to auto-populate. It's going to say, hey, I would think this is what happened last time. And then if you look at the split, it's going to say, here's the split that happened. Now this amount's the same, and so this could be useful, but the split is not. So if you wanted to use this kind of system so that it memorizes the prior transactions, which could save a lot of time and help anybody that enters the entries to kind of know this entries better, it doesn't really work for this particular transaction if you use the amortization table. However, if you make up a system where you don't use the amortization table and just record everything to the loan payment, and then think about making an adjustment at the end of the month, or having your accountant make the adjustment, giving them the amortization table and this information, let them make the adjustment, then you can use this kind of system and the system will just automatically kind of remember what happened last time, which makes the data input a lot easier. So in other words, if you remove the interest, just record it to the loan principal, and then just record the same transaction each time, the system will remember that transaction, and then just make an adjustment periodically at the end of the time period to break out the interest versus principal portion. One of the options that you have. Again, we're not gonna record this item. If you want to not record it, if you put this in here, you can clear this information, and you can close this. And if you go out of this window without hitting record or enter, that's another way it'll not record it. If we say you have recorded this transaction, do you want to record it now? We're going to say no. And then if you go back into the check register, it's always useful to go back in and double check that it has not been recorded. So here's where we left off. For more accounting information and accounting courses, visit our website at accountinginstruction.info.